Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of How to Analyze a Balance Sheet, a simple guide to financial insights. Contributed capital. This is the money invested by owners or shareholders in exchange for ownership. For corporations, it includes common stock and preferred stock. Essentially, this is the initial and additional funding that the owners contribute to the business. Retained earnings. These are the profits the business has kept after paying expenses and dividends. Instead of distributing all earnings to shareholders, companies often reinvest profits to grow operations, pay off debts, or save for future needs. Retained earnings grow when profits are reinvested and shrink if the company incurs losses or pays higher dividends. Together, these components reveal how much of the business's operations and growth are supported by internal resources, profits, versus external funding, debt, or additional capital contributions. Impact of dividends on equity. Dividends directly reduce retained earnings, which is a major part of owners' equity. When a company pays dividends to its shareholders, it distributes a portion of its profits, leaving less retained earnings on the balance sheet. Here's how it works. The company declares a dividend, creating a liability until it's paid. Once paid, total assets, like cash, decrease, and equity reduces because retained earnings go down. While paying dividends can make a company attractive to investors seeking income, it also means the business has fewer resources to reinvest in growth. For example, a company that consistently pays a high percentage of its profits as dividends may struggle to expand or weather financial difficulties. By understanding owners' equity and the effect of dividend payments, you can assess how a company balances rewarding shareholders with maintaining operational and financial flexibility. Analyzing the balance sheet. When it comes to assessing a company's financial health, analyzing the balance sheet is crucial. It provides insights into liquidity, solvency, and financial stability. By exploring key ratios, you can understand how well a business is managing its resources and obligations. Let's break this down into two critical areas: liquidity and solvency. Liquidity ratios. Explain current ratio and quick ratio and their importance. Liquidity ratios help determine a company's ability to meet short-term obligations using assets that are readily available. These ratios measure how quickly a business can turn its current assets into cash to cover liabilities. Two commonly used liquidity ratios are the current ratio and the quick ratio. Current ratio. The current ratio compares a company's current assets to its current liabilities. Formula. Current ratio equals current assets divided by current liabilities. A ratio of 1 or higher typically means the company has enough assets to cover its short-term debts. For example, if a business has $500,000 in current assets and $300,000 in current liabilities, its current ratio is 1.67. This suggests it's in a solid position to manage near-term payments. Why does this matter? A higher current ratio usually signals financial strength. However, an excessively high ratio could indicate underutilized resources, like idle inventory or unused cash. Quick ratio. The quick ratio, or acid test ratio, sharpens the focus by excluding inventory and prepaid expenses. It only looks at the most liquid assets, such as cash, accounts receivable, and marketable securities. Formula. Quick ratio equals current assets inventory prepaid expenses, divided by current liabilities. Let's say a company's current assets are $400,000, of which $150,000 is inventory and $20,000 is prepaid expenses. If its current liabilities are $200,000, the quick ratio would be 400,000, 150,000, 20,000, divided by 200,000 equals 1.15. A quick ratio above 1 indicates a strong ability to pay off short-term obligations without relying on selling inventory. Why is this important? Inventory might not sell as quickly as expected, so the quick ratio gives a clearer picture of immediate liquidity. By using these ratios, you can assess whether a company is prepared to handle unexpected expenses or downturns. Liquidity is like having a safety net. Without it, the business may struggle to stay afloat. Solvency ratios. discuss debt-to-equity ratio and interest coverage ratio. While liquidity looks at short-term health, solvency ratios focus on a company's ability to meet long-term obligations. These ratios help gauge financial stability over time, highlighting the balance between debt and equity. Two essential solvency ratios are the debt-to-equity ratio and the interest coverage ratio. Debt-to-equity ratio. This ratio compares the company's total liabilities to its equity, showing how reliant it is on borrowed funds. Formula. Debt-to-equity ratio equals total liabilities divided by total equity. If a business has $2 million in total liabilities and $1.5 million in equity, the debt-to-equity ratio is 2 million divided by 1,500,000 equals 1.33. This means the company uses $1.33 of debt for every $1 of equity. A higher ratio indicates more reliance on debt, which could be risky in economic downturns. Conversely, a lower ratio suggests the business leans more on its equity to fund operations. Why does this matter? Too much debt can lead to financial strain, while too little may limit growth opportunities. The right balance depends on the industry and the company's overall strategy. Interest coverage ratio. This ratio measures how easily a company can pay interest on its debt using its earnings before interest and taxes, EBIT. Formula. Interest coverage ratio equals EBIT divided by interest expense. For example, if a company has an EBIT of $500,000 and an annual interest expense of $100,000, the interest coverage ratio is 500,000 divided by 100,000 equals 5. This means the company earns 5 times its interest payments. A higher ratio signals a healthier ability to handle debt servicing costs, while a lower ratio, less than 1.5, could raise red flags about financial instability. Why is this important? Think of it like having monthly rent payments. If your income comfortably covers the rent, you're in good shape. But if your income only barely covers it, or falls short, you're in trouble. Companies face similar risks with their debt obligations. By analyzing solvency ratios, you get a clear picture of whether a company can sustain its operations in the long run or if it's teetering on the edge of financial trouble. These metrics are critical for anyone looking to invest or lend money to a business. Common mistakes in balance sheet analysis. Analyzing a balance sheet can uncover valuable insights, but it's easy to misstep. Mistakes in interpretation can lead to poor decisions, whether you're an investor, analyst, or business owner. Let's explore 2 common errors that can undermine analysis. Overlooking off-balance sheet items. Off-balance sheet items are financial obligations or assets that don't show up directly on the balance sheet. Examples include operating leases, special purpose entities, and certain joint venture commitments. These items can significantly impact a company's financial health, yet are often ignored. Why does this matter? Off-balance sheet items can paint a false picture of a company's true financial position. For instance, a company might lease equipment instead of purchasing it outright to keep the lease commitment off the balance sheet. While this makes liabilities look smaller, the company is still responsible for the lease payments. Ignoring these items is like overlooking hidden debts when assessing a homeowner's finances. You might think they're doing great based on what's visible, but surprise obligations could strain their budget. To avoid this mistake, it's critical to review footnotes and disclosures within financial statements. These sections often detail off-balance sheet items and give context to their potential risks. Misinterpreting equity figures. Equity is the residual value of a company after subtracting liabilities from assets. Misunderstanding this figure can lead to bad decisions. One common error is assuming high equity automatically means a healthy company. While strong equity is often positive, it doesn't tell the full story. For example, retained earnings, a major component of equity, may include years of accumulated profits. However, those profits aren't always cash on hand. They could already be reinvested into assets or used to pay off debts. Without digging deeper, you risk thinking the company has more flexibility than it does. Another mistake? Ignoring the quality of equity. If a company frequently issues new shares, equity might rise, but existing investors' ownership gets diluted. It's like owning a slice of pie that keeps shrinking as new pieces are cut for others. To avoid misinterpreting equity, Focus on its components and changes over time. Ask yourself, are retained earnings growing steadily? Are new contributions from owners or stock issuances sustainable? These details provide better insight into how well a company is managed and whether it's creating value for shareholders. When you avoid these common pitfalls, your balance sheet analysis becomes sharper and more reliable. Identifying these errors is the first step toward making sound financial decisions. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.